Hello, very good morning to all. Welcome to today's Daily Dose of Market Insights. I'm Kelvin Wong here, the Senior Market Analyst of OANDA Asia Pacific. Very good morning. Today will be Tuesday, the 20th of February 2024. So before we start our Daily Dose of Market Insights, as usual, the disclaimers slides. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the this advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so as usual, what we will start our daily dose is we'll have a recap of what happened overnight and what has taken shape in terms of key events and key data that has been released earlier before 11 a.m. So as we know that yesterday the US markets are closed or were closed for a public holiday, so markets will be pretty much muted in terms of the cross asset class movement. But what's interesting over here is gold prices continue to firm up above that 2010 level XAU/USD, and oil price, WTI crude oil, that means the West Texas crude oil, managed to actually inch slightly higher, but still no clear breakout of a 3.5 month range resistance at around $78.40 US dollar per barrel. So these are, I mean, it's a kind of very quiet market movement overnight, due to the fact that the US market is closed, then dollar is pretty much mixed as well. So before we jump straight into the short-term technical outlook on the cross asset classes, I want to share with you one key event that took shape earlier this morning at 9:15 a.m. Singapore time, which was the China Central Bank. So the China Central Bank actually cut the loan prime rate. Okay, one of the loan prime rate. Okay, so for China, as you all know that the monetary policy is not so straightforward as the rest of the major economy like the US, UK, and Eurozone, where their central bank, the respective central bank will only have one benchmark policy rate, whilst for China, there are actually three benchmark policy rate. Yes, one will be the 1 year medium term lending facility rate, so that's the interbank rate, and also we do have the prime rate, where we could actually tie to benchmark it according to corporate and personal loans as well as mortgage loans. So in China today, there's another two more benchmark rates which they actually held their decision for today, which is the loan prime rate for 1 year. So 1 year loan prime rate is a proxy, it's a benchmark used to price for corporate and personal loans. And you have this 5-year loan prime rate. So this 5-year loan prime rate is actually benchmark for mortgages, home mortgages. So as we know that China itself is now facing a deflationary risk spiral scenario. It's a heightened deflationary risk spiral scenario driven by the fact of a very weak property development market. All right, so in order for the central bank to actually hopefully to boost a bit of demand from the property side of the story, they decided to actually reduce the 5-year loan prime rate by 25 basis point. So it's way beyond market expecting. Market is only expecting a token of a 15 basis point reduction to 4.05. So instead, the central bank actually reduced it by 25 basis point, okay, to 3.95. So if you look at the trend of the loan prime rate in the 5-year basis over here, okay, so this is the 5-year loan prime rate. So the 5-year loan prime rate, today's reduction of 25 basis point is the most so far in history. Okay, this is a very short history because this loan prime rate system is only kickstarted in 2019. All right, both on the 1 year and the 1 year and the 5-year, pardon me. So that's why you explained, if you go back to maximum, okay, it's only up to this level. It's a very short time history because it's a newly kind of enacted monetary policy framework from the China Central Bank. So today's cut is the deepest compared to previous cuts prior to the we call it exposed COVID-19 scenario. So but the thing over here is that today's cut itself is rather muted in terms of market performance. So we do not see a very sharp push up in China related equity. So in fact, if you look at China related equity over here, the Hang Seng actually saw a bit of profit taking today, down negative 20%. The HSCEI, that means the China in H shares index, down negative 3%, and the China A50 down also negative 3%. And in fact, the housing sector is the housing property, the CSI 300 real estate index. That means there's a kind of a proxy for the real estate stocks in China, almost unchanged. So it's not much of a big fireworks in terms of spreading a bit of, it did not spread a risk on behavior in the markets for sure, because I believe that market participants still wants to have more concrete policy details, especially from the fiscal side of the story instead of the monetary policy side, to boost directly consumer confidence as well as business confidence to actually negate this ongoing deflationary risk spiral. So once you hit a deflationary spiral, if you all know that the further it cuts interest rate, it may reduce the so-called marginal benefit of looser or accommodative monetary policy, despite the fact that because people are not confident of spending in the economy. So that's why that actually explains why the markets are actually not reacting as positively uh, due to the further accommodating monetary policy enacted today by the PBoC, China Central Bank. All right, so that's pretty much sum up for the key data or highlights that I'll share with you all. Now let's jump straight to the short-term technical outlook. So let's start with the FX market first. So very interestingly, if you look at the FX market on my screen over here, this is the usual 5-day rolling performance chart of the major currency pair quoted using dollar as a base currency. So what it means that if all the lines are sloping downwards, that means dollar strength is giving back. If it's inching upwards, that means dollar strength is back into the picture. So using dollar as a base currency. So what does it mean? That means $1 equals to how many sterling? $1 equals to how many euro? So you could look at my screen over here in my what we could see over here is in the last 5 days after that initial spike up in last Tuesday or Wednesday due to the hotter than expected CPI print, the dollar strength has started to be pretty much abated or muted, and overall it just traded sideways. Okay, the FX market just traded sideways for now, no clear signs of direction. But what's interesting over here is that in the last 24 hours or so, we do see the dollar strength coming back into the Aussie and Kiwi. So what we could see over here is that this initial gap, this wide gap between the Aussie and the Kiwi and the rest of the currency is playing a catch up. That means, i.e., that means we see a bit of dollar strength, minor dollar strength, mind you, not major, because this is the 5-day rolling performance coming back into the Aussie dollar. That means dollar is strengthening against the Aussie, dollar is strengthening against the Kiwi. So something very interesting to look out for is a bit of what we call a mean reversion to cover this gap. Okay, because in the last 24 hours or so, the dollar actually weakened against the Aussie and Kiwi against the rest of the pack. So now it's covering this gap. On top of that, right now there's no actually key economic data related from Aussie and Kiwi as well. So it's more related to flows and technical factor. Okay, so with that, let's jump straight into the technical picture of the Aussie dollar. So if you look at the Aussie dollar, this is the daily chart of the Aussie dollar. So the Aussie dollar over here actually refuses to actually surpass the 200-day moving average that's acting as a resistance at around 65, 60 level over here. Okay, and if you look at the daily RSI, is neither here nor there as well. It's still inching below the 50 level mark. Clearly no signs of medium-term upside momentum coming back into the Aussie dollar. This is a daily chart. So if we switch down to the short-term technical outlook, as I show you all on the daily basis, which is the hourly, using the hourly chart to actually decipher the potential intraday short-term movement. All right, so now before that, let me expand my screen so that you guys could see much clearer. Okay, good. So this is the Aussie dollar. So the Aussie dollar still refuses to go surpass the 200-day moving average and as well as the 20-day moving average as well. And also where it reacted negatively off this descending trend line resistance that I drew from the high of 31st of Jan, what you could see on the screen here. And what's interesting, in the last few sessions, like I shared with you all, the Aussie dollar strength coming back against the dollar has not been reflected positively by its hourly RSI. Why do I say that? If you look at it, price action going to inch up higher high. Upon hitting the 20-day moving average, that it reacted. Then prior to that reaction, if you start to see the price action of the hourly RSI is sloping downwards, going against the movement of the price action, the raw price action of the Aussie dollar. So RSI, what is RSI basically? Right? RSI is actually a derivative of price action. Take it as a very a modified rate of change. So anything that's rate of change, right, is momentum. So rate of change momentum tends to have a leading element over price action. Think of it as a car moving in a direction. So in order for a car to slow down, it got to in order car to stop moving, it got to slow down its speed first. All right, so this is what an RSI divergence tell us, all right, or indicate to us. So what it means that previously we see the push up in the Aussie dollar, but this push up in the Aussie dollar is right now telling us that this push up is about to stop or reverse direction. Why? Because of the bearish divergence at the overbought level that's being depicted on the hourly RSI. So with this emergence of this new we call it new bearish elements that took shape in the last 6 or 7 hours or so, we will be flipping to a bearish bias for today on the Aussie dollar. Still recall that those who actually followed our daily dose of market insight yesterday due to mixed element, we do have a neutral bias between 65.70 and 65 figure level. Okay, because of this latest negative element, we are now flipping to a bearish bias using 65.70 as my short-term pivotal resistance. All right, looking for potentially push down to test 65 figure, breakdown exposes 64.70 next. Okay, so what's 64.70? So 64.70, if you do the FIBO retracement of the entire previous minor push up, is the 76.4 FIBO retracement, and also correspond to that former minor swing low of 5th of February. All right, so only an hourly close above 65.70 will invalidate this short-term bearish view for today to see a potential squeeze up to retest the 50-day moving average, also confluencing with this minor range top in places 24th of Jan to 31st of Jan, all confluencing at a similar resistance level at 66.20. Okay, so that's for the Aussie dollar, flipping to a bearish bias below 65.70 short-term pivotal resistance for today. Dollar yen. Okay, so dollar yen, no change, going to trade sideways below our short-term pivotal resistance that we highlighted yesterday at 150.70. So we'll be still using 150.70 as a short-term pivotal resistance. Still maintain that bearish bias. First support level to watch for sure will be last Thursday minus swing low at 149.60 that confluenced previously with the minus swing high of 9 of Feb, and 30 of Feb now turns into a pullback support. Okay, so this will be the first support level to watch. A breakdown below it exposes the next support level, which confluence with the 20-day moving average 14880/14840. Only an hourly close above 150.70 will invalidate this short-term bearish bias to see a squeeze up to test the major resistance zone of 15140/15195. European currency, the sterling dollar going to trade sideways above the 200-day moving average. So no change, still maintain that neutrality bias between these two neutrality range. Upper limit 126.75, lower limit 125.40. Okay, for the euro dollar, so euro dollar yesterday attempted to actually test again the upper limit of the neutrality range that we highlighted yesterday, 107.95, but refused to break up and continue to inch trade sideways thereafter. So no change, still remains a neutrality bias between these two range for today at 107.95, 107.25 for the euro dollar. All right, so all in all, net we do see a very mixed a picture for the FX market, at least from a short-term basis. Major stock indices. So let us start with the Hang Seng. Okay, so for the Hang Seng, no change. In fact, it started to inch much lower from yesterday's close. Okay, so right now based on our Hong Kong 33 is down negative 0.7%, but still holding above our yesterday's short-term pivotal support that we highlighted, pardon me, at 15,930, also corresponding to the 20-day moving average acting as a support as well, pretty much close to this level. So still no change, still using that the 15,930 level as a short-term pivotal support level to maintain this potential bullish bias for this very likely ongoing minor counter trend rebound scenario to continues to play out. First resistance to watch will be at 16,525 for today. All right. However, an hourly close below 15,930 will invalidate this view or put jeopardy into this counter trend rebound scenario to see kind of a push down towards the next support level at 15,720 and even potentially 15,300 level. Nikkei 225 or the Japan 225 Bitcoin platform. Today, we still see a bit of weakness, down negative 0.4% as based on our platform now, but still holding above our short-term pivotal support level. After earlier this morning, it has a spike up to retest about to test that all-time high level again at 38,957. So as long as 38,260 short-term pivotal support holds, we will still maintain that bullish bias. First resistance to watch for sure will be at the current all-time high at 38,957, then thereafter followed by 39,210. Only an hourly close below 38,260 will negate this short-term bullish tone to see the extension of this minor corrective decline within a short-term uptrend that's still intact towards the next support level at 37,570, which correspond to the minor swing high area of 14th of February, and as well as this dotted former major ascending channel resistance or upper boundary that turns into a pullback support level right now. German DAX. So German DAX yesterday continued to this Asia session going to break down, all right, below that neutrality level. Yesterday we were neutral between 17,130 and 17,060. So given right now it starts to break down below this level, so it seems to us that last Friday price action over here, this little spike up you can see on my screen is a fairly bullish breakout from this expanding wedge or expanding triangle configuration that is in place since the high of 30th of Jan. Okay, if you look at these two lines are broadening up, so what you could see over here is still it's a very messy, choppy sideways range configuration, and given that it's reintegrate back into that range and start to trace a series of lower high, so with that it could means that potentially it could start to transverse back into the middle of this expanding triangle or wedge configuration. So with that, we'll be using 17,130 for today as a short-term pivotal resistance level for a potential a mean reversion scenario back towards the middle part of this expanding wedge configuration in the short term, with the near-term support level to watch at 17,100 level, followed by 16,950, which also correspond to the 20-day moving average as well. Only an hourly close back above 17,130 will invalidate this short-term bearish mean reversion view to potentially see another round of a spike up to test 17,200, followed by 17,260 resistance level. All right, US major indices. So US closed yesterday. So today, right at the start of the Asia session, there's a bit of a sell-off right now, down negative 3%, but still holding above the 20-day moving average and the short-term pivotal support that we have since last Friday at 38,365. So no change, still use 38,365 as my short-term pivotal support level. Okay, still maintain that short-term bullish bias on the US Wall Street 30, which is aka Dow Jones Industrial Average. First resistance to watch 38,950/38,970. All right, then what we have for the Nasdaq 100 right now is testing the 20-day moving average, which is also corresponding to that short-term pivotal support that we have since last Friday, 17,630. So very similar to the US Wall Street 30, aka Dow Jones Industrial Average. So in today's Asia session, you also see kind of a sell-off as well at down negative 0.6%. Okay, due to the fact that yesterday there was a closure of the US stock market. So first resistance to watch, so still maintain that bullish bias, 17,630 short-term pivotal support. First resistance will be at 17,840. So that was kind of the last Friday's minor swing high area. Above 17,840 potentially sees a retest to the previous all-time high area at 18,000/18,030 level. Only hourly close below 17,630 will negate this bullish tone to kickstart another round of minor corrective decline towards 17,500/17,350 support level. Okay, so that's pretty much sum up for the major stock indices. So for the major stock indices, all the stock index that I share with you are still holding above their respective short-term pivotal support level, short-term pivotal support level. Only the German 30 right now is showing signs of weakness, potentially to start doing a bit of mean reversion decline back into the middle part of its ongoing minor expanding wedge configuration since middle of January last year. All right. Right now, what we are supposed to do right now is let's us take a look at West Texas oil. So West Texas oil over here, no change, still holding above the 78.40. Then I give a bit of excess 79 figure level. So that is the medium term, we call not medium term, that triangle, symmetrical triangle range resistance that is in place since the high. Since the what do you call it, the swing high of 14th of November 2023. So this will be a West Texas oil range configuration. So all in all, right, what we could see right now over here is that this push up towards the range, or that retesting of the range since last Friday, momentum is rather weak despite price action going to churn higher high, but this higher high is not moving in synchronized movement by the RSI, where the RSI going to shape lower high. Okay, so what this is what I call a bearish divergence as well. That means momentum is losing strength despite the West Texas oil is churning slightly higher. So with that ongoing bearish divergence that's being depicted by the hourly RSI, we will still maintain that short-term bearish bias for a potential mean reversion decline back down towards the range, symmetrical triangle range configuration space. Okay, this white space over here. So using 78.40, 79, the access as a short-term pivotal resistance. First support level to watch will be at 77.25. A breakdown below 77.25 exposes the next near-term support at 75.75. We also confluence with the 20-day moving average. All right, only hourly close above 79, access short-term pivotal resistance will invalidate this mean reversion decline scenario back into the range to see a potential squeeze up towards the next resistance at 79.80, followed by 81.65 level. Now spot gold lastly, so spots was what we see in spot gold right now over here is price going to churn higher within this also a symmetrical triangle range configuration that I draw by this dotted gray, this upwards sloping, this gray boundary line. Okay, so the upper limit of this symmetrical triangle range lies at 2042. Look at this descending range line that I drew from the high of 28th of December last year. So with that, right, still no change, still using the lower boundary support level of this symmetrical range triangle configuration, which is at 1986, we saw confluence with last Wednesday's swing low. So as long as 1986 short-term pivotal support holds, potentially it could churn within this to test the upper limit of this symmetrical triangle range configuration. First resistance to watch will be at 2028, which confluence with the 2050 and the 20-day moving average. Above it exposes 2042, okay, which is the upper limit of this symmetrical triangle range configuration, and as well as confluence with the minor swing high of 5th of Feb and 7th of Feb. Only hourly close below 1986 will damage this view to see a further push down to retest the 200-day moving to retest 1975/1965, which confluence with the minor swing high area of 11th of December or 12th of December that give rise to that previous spike up in gold price, and as well as the 200-day moving average acting as support at 1965. All right. So net still maintain that short-term kind of bullish bias within a range scenario for spot gold XAU/USD. So with that, that pretty much sum up for the short-term technical outlook on the various cross asset classes. So before we go, let's take a look at the calendar or what are the key things to look out for today. So for today, pretty much quiet at the European session as well. We do have three BoE Bank of England officials speaking with the governor, but is speaking at 6:15 p.m. Singapore time, then followed by other two officials, BoE officials, Broadbent and Dhingra at 6:15 p.m. Okay, all at the same time. So I believe that there's some conference going on where the governor and as well as the other two BoE officials are speaking at 6:15 p.m. Singapore time. And over at the US session for today, yeah, we do have the Conference Board Leading Index. It's a leading economy index that is especially a composite index that take into account of financial metrics, market metrics, and as well as liquidity metrics to construct this Conference Board Leading Index. So this particular index is one of the market participants that I'm watching out for. Because why? Because this leading index is still showing signs of recessionary risk in the second half of this year in US. Okay, so this pretty much interesting to watch for the latest reading. Why? Because market participants or consensus is expect a further weakening on the index on a month-on-month basis to negative 0.3% for January, inch much lower from negative 0.1 previously in the month of December. So that's at 11 p.m. Singapore time today. All right, so with that, that pretty much sum up for today's daily dose of market insights. So do have a great day ahead, and we shall speak again tomorrow. Thank you.